Open eye, feel the waves cut through me, hypnotized by the sounds I'm breathing in. Hold tight, hold tight.
What's up, guys? Nick Foy here, the founder of Under30Wealth.com and the creator of this YouTube channel where I bring you daily uploads covering mostly real estate investing, but we also get into other wealth building topics. So the whole goal behind my brand is to teach you, whether you're a teenager or a college student or early 20s, late 20s, how to build wealth under the age of 30 and get yourself set up to retire early and, live that life that you dream about financially. So I got started investing in real estate age 20. I'm now 22. I've built a net worth over $300,000. I don't really say that to brag. It's more just inspiration, because I never thought it would be possible to do it this quickly. I always had the goal of trying to become a millionaire by age 30, and now I've set myself up to reach, millionaire status before age 30. So I'm trying to give out as much value as I can on this channel, giving, daily uploads, free information, free tips to you to help you get started with your real estate investing journey. So today's video, we're going to be talking about how to value multifamily properties. Now, when I first got started investing at age 20, I bought a single family home. That's the route most people take. They'll buy a single family home, which is just a house in a neighborhood. We talked about in the last video how to value these single family homes that are in residential neighborhoods. And then today's video is going to be about apartment investing and multifamily properties. So if you want to check out that previous video, I can link to it below, or you can just check out my channel and go back to the previous video. So those houses are valued based on comparable sales of other houses. Now, apartments are a little bit different. Since apartments are limited, the buyers that are buying apartment buildings, you're typically dealing with investors. So with single family homes, you've got investors and homeowners trying to buy the house to actually live in the house. But apartments, since it's just an investment property that produces income, typically the buyer and seller of these as investors. So to value an apartment building, you're going to have to think like an investor. They're going to look at the income that the property produces, because there's lots of different apartment complexes out there that they can choose from. So you're going to want the property that's got the best income potential, the best return on investment for the amount of money that you're paying for the property. All right, so typically there's this thing called the cap rate, and that's the rate that investors will judge properties by. So the cap rate is simply just the return on investment of the property if you were to pay all cash for it and not take out any loans or anything. So let's say we had like a $500,000 apartment building that's producing, $50,000 of net income. So after all your expenses are subtracted, you're left with 50 grand. So that $50,000 a year divided by the $500,000 purchase price of the building would net you a return of 10% on your money. So, in 10 years from now, after you've earned 50 grand over those 10 years, you're gonna have, paid off that investment and doubled your money. So it's a 10% return. So basically a cap rate in that area, might be 9%, 6%, 7%. It just depends on what market you live in. So that's the return investors expect to get on a property. So that's how they compare similar properties. So they're going to look at one property and say, okay, this has a 4% return. This other property's got an 8% return. I'm probably going to go buy that 8% return property. So cap rates is how they're going to value it. There's going to be an average cap rate. So all these properties are going to be selling at different returns. So you're going to have, 4, 5, 6, 7, 8, all the way up to 20, 30% returns in some cases. So there's going to be an average. So Miami, for example, when I was working down there for a couple summers, they have a cap rate of like 3 or 4%. They've got hedge fund money coming in where they're looking for any type of yield. So even though a 3 or 4% return seems really small, they can borrow money from a bank at 2% interest. They can turn around and buy a property that produces 4% interest. So they're making a net spread there. They're paying the bank 2% interest, but they're making 4%. So they're still making a positive spread, which helps boost, a hedge fund's bottom line and, gives the investors of a hedge fund money back. So hedge funds, they typically go into those bigger markets like Miami, LA, Washington, D.C., Seattle. But when you get out into the more rural, the Midwest, you can typically find cap rates that are a lot higher at 8, 9, 10, 12%, sometimes even higher than that. So I had to go downtown for the multi-unit building we bought as our second property. It was a 3-unit. It's got commercial space downstairs, and then 2 upstairs units are going to be rented out to individuals that want to live in it, like studio apartments. So this 3-unit building, I had to go down and find out what the cap rate is in our city so that I could see, what typically, depending on what kind of income the property produced, then you would take that cap rate to try to figure out what value the building is. So that's where we got to get into the formula now. And then I'm going to actually go through a spreadsheet example with you as well. We're going to look at some different properties on LoopNet, and you'll be able to see right away where it says cap rate and net income and things like that.
A few moments later.
The formula for investing is property value equals the net income divided by the cap rate. Or we could rearrange that formula to say the property value times the cap rate equals the net income. Because remember, cap rate is just return on investment. So if you take the property value of $500,000, like our example earlier, multiply it by the cap rate, which is just another word for return on investment, and we said let if the cap rate's 10%, so that $500,000 times 10% equals $50,000 of net income. So property value times cap rate equals net income, or to figure out property value, you have to divide that cap rate over on the equation to get it over to the other side. So property value equals net income divided by cap rate. So in other words, $50,000 of net income divided by 10% equals $500,000. So doing a little bit of math there, I hope you were able to comprehend that and it stuck with you. It's been a while, some of you maybe since you've been in school doing those equations and that kind of math. But it's pretty simple, property value equals net income divided by the return or the cap rate, whatever you want to call it. So when I go downtown to the appraiser and I say, what have you been seeing things go for in the city? He said, typically cap rate around here is like 10%, 10.5% in my case. So what I'm going to do then is go back and see, okay, how much rental income could my building produce? What are all of our expenses? Once we subtract that, we're going to get our net income. So I projected maybe a net income of around, 20 to 25,000. It's going to vary because there's some common area expenses we don't know how much those are going to be. But to make math simple, let's say we're going to make net income of $25,000 a year. So then taking that net income of 25 grand, dividing it by a 10% cap rate, that's going to put the value of the building at $250,000. So another investor is going to expect to come in and pay 250 grand and get a 10% return on investment. So they're going to be making $25,000 a year return on that $250,000 investment. That works out to 10% return, which is consistent with, the cap rate, the market rates that other buildings have been going for when investors are buying those other buildings. So that's kind of, it's probably confusing if you're completely new to this, trying to understand how it all works, but just think about it from an investor's perspective. You wanna buy properties that get you an investment return that's comparable to what other properties could get you. Otherwise, you're always gonna wanna go after that property that has the highest return, right? So once you know what the average return on investment is for properties and like multi-unit properties, then you can take that and apply it to the net income to try to put a value on the building. So when you're looking at a property like we're about to do in a second on LoopNet, you're going to want to look at what the net income is, and then you're going to want to try to understand what the cap rate is for that market to try to figure out, ideally what the value of that property is worth that you're willing to pay. All right, guys, so now let's get into doing an example demonstration on LoopNet. So when you're buying commercial real estate or apartment buildings, one of the places you can go to find these types of properties for sale is LoopNet. And then the other method would be, having a real estate agent set up a search in the MLS for apartment buildings. But in the meantime, to do self-research, you need to go to loopnet.com. All right, once you arrive at LoopNet, you need to enter your city. So I'm going to do a couple different cities just to show you a comparison of the cap rates. So first, let's go ahead and start out in Miami, Florida. Since this is where I interned for a couple summers, I got somewhat familiar with their market, and their cap rates, you're going to notice, are really low. All right, so it's going to show you some different features here. So you've got the list view over here. You've got the city or zip code that you're searching. You can set filters here of for sale. You've got property types, prices, building size, other filters and sorting methods, and then you can save your preferences. So over here on the map, you can see beautiful Miami, Florida down here. And it currently has lots of different properties showing since we don't have any filters set yet. So let's go ahead and look at property types. We'll do multifamily. That way we can just single out apartment buildings. And then price range, we'll go ahead and set at least a minimum of $1 million. So if you've got, a couple $100,000 saved, you might be able to make a down payment on $1 million or bigger apartment building that's got lots of units. So after entering our $1 million minimum price range, it's going to spit out a bunch of different results. So over here on the left-hand side, let's look at some of these different examples. So right away, you're going to see it displays cap rate, number of units, the building size, what type of apartment it is. If it's a low rise, it's going to be, 2 or 3 floors that you can get up by stairs. High rise typically has those elevators built in the building. So it's a little bit different of a layout. So these buildings are all going in the $2 to $3 million range, and you can see the cap rates in Miami. Like I said, they're usually pretty low because investors, you're dealing with a lot of hedge funds and bank money and just big investment companies that are trying to buy where they can get any spread or any yield. So they're going to be borrowing, at 2 to 3% from the bank, and then they're trying to get a spread yield at 5.4%. So that's making them more money than what they're borrowing at. So they're effectively using leverage. So the net income, basically, this is what the cap rate is. Remember our formula. So whatever the 5.4% is times the 2.2 million. So if we were to get out a calculator, now you can click on the listing and it'll actually show you the net income sometimes, but we'll do it manually to practice that formula. So 2.2 million is the price that they're asking. And at that price, it would create a 5.4 cap rate. So we got to multiply it by 5.4% to see what kind of net income results in a 5.4 return on investment. So $118,000 is about what you would make per year by buying this building here that's 2.2 million. And then we've got this building up here that's 2.95 million. So if we were to pay, the price they're asking for and not negotiate it down at all, we'd be getting a net income of 2.95 times 7.6% is the cap rate. So $224,000. So as you can see here, you're spending, a little bit extra money for this building because it has more units, and you're also getting a bigger net income compared to the other deal. So that's why the cap rate's 7% here and 5% here. So you're getting a better return on investment here. But now as far as how you make the big money in multifamily investing, so ideally you want to buy a property that's got, some issues with its balance sheet. Just like when you're buying single family homes to go fix and flip, you're looking for distressed properties that need work. So in the apartment complex space, you want to find apartment buildings that need work. So, the units might need updated. The outside of the property, the landscaping probably needs updated. By doing these things, you can then start charging higher rents because tenants are going to be willing to pay more for a nicely renovated building compared to a broke down, crappy building that, they don't want to spend that kind of money to live in, those kind of conditions. So by upgrading all the units and making the apartment really nice, you could charge higher rents. So what that's going to do is that's going to increase the amount of rental income you're collecting per year. And then after all your expenses, you're going to have more net income compared to previously. So when you go in and buy these properties, you're looking for ways that you can increase the net income, since the net income is what is the value is based off of. So in Miami, if the cap rate's at 5%, then if you can go in here and take this net income on the first property, so right here where it sold for 5.4% at 2.2 million, we did the math and it was spitting out $118,000 of net income. So if we could go in there and, you know, fix up these units, get the rents higher, cut some expenses down, fix that balance sheet up, we might be able to get this net income from 118,000 up to like 150,000. So using the formula, if we can increase it to net income of 150,000, and then we go to sell it at that same 5.4% cap rate that we bought it at, now we just increase the building's value to 2.7 million. So we just added $500,000 of value to this building, and that's going to be, you know, money in your pocket that helps build your net worth. So a few days ago, I had a video I published about, you know, how do you make millions of dollars and how do you become a millionaire through multifamily investing. So we started to get into these points, but I guess I didn't quite do an example like this, getting thorough enough with it, so I'm covering that today. So here's like a math example showing you how apartments make you the big bucks. You can go in there, just raise the rents, cut down the operating expenses to improve your net income. And since multifamily buildings are valued based on their cash flow, their net income, that's how you can add, you know, insane amounts of value to this apartment building. And you can create, you know, $500,000 of wealth within probably a few years time period of fixing up all the units, getting it fully occupied and having, you know, no vacancies and things like that. All right, so that was the math side of things, again, to help you further understand it. So let's go ahead and open up this example listing that we've been doing. So 2.2 million, 5.4% cap rate. So you can open up the listing. It's going to show you who the listing broker is. You can call them if you've got any questions, but ideally you want to work with a buyer's agent because they're going to help you get the best price. You can scroll through the different photos. So this was the 10-unit building, so we can see what kind of shape these units are in currently. So it looks like they've got pretty nice appliances. They've got nice big tile floor. The bathroom appliances look pretty nice. The vanity's got, you know, like a granite countertop look. The kitchen had a granite countertop look. So those units look pretty nice. That's probably why it's selling at a low cap rate at 5.4%. If the property was in distressed condition, you know, those apartments were really beat up and outdated, then they might not be able to charge the 2.2 million. They might, you know, only be able to get 1.8 or 1.7 million for it. So if the net income, you know, was the 180,000, you divide that by, you know, whatever the sales price is that another investor thinks the building's worth. So if another investor only wants to pay 1.8 or 1.7 million for that amount of income, that would raise up the cap rate because of the condition of the building. But in this case, the condition of the building looked pretty nice, so that allows them to charge a lower cap rate. All right, so looking over some of the other information, we've got price here, 2.2 million, number of units, 10. So if you divide price by number of units, you're paying about $220,000 per unit. Building size, 6,500 square feet. And here they break it down for you. They actually computed it already, price per unit. So that's that calculation I just did, $220,000 per unit. Multifamily is the property type. Property subtype, it's a garden apartment or called a low-rise apartment. It's an investment property. You get the parcel number if you want to look up the tax records. They've got lot size, the year built, number of stories. It's at 100% occupancy. So again, this is what I was talking about. If a building's fully occupied, it's in really nice condition, then that's probably the investor who bought these. They probably fixed them up, got them fully occupied, made the apartment really nice and producing the maximum amount of income it could, and now it's trying to sell out at a low cap rate so that it could get the max value possible. Now on the flip side, when you're going in to buy it, the occupancy might, you know, be at 70%. So in that case, it wouldn't be producing $118,000 of revenue anymore. Now it might be producing more like $70,000 of net income because some of those units are vacant, so you're not able to collect the annual rental income from those units. And that's going to hurt your overall net income, which then hurts the overall value. So this person, they probably bought it at a lot cheaper price. I'm guessing maybe under $1 million or around $1 million for these 10 units. And then over time, they've fixed them all up, got the whole place occupied, and now they're trying to sell out at that market cap rate of around 5% in Miami. Moving on down here, you can see the description. Then they give a little financial summary. So there they did the calculation for you of the property value times the cap rate equals net income. So that's that $118,000 we've been talking about. Then you get, you know, a little bit more information here. And you can see this agent's other listings that she does. So she's in the commercial space, obviously. She's got other buildings for sale. So she's somebody, like I said, you could contact for more information about this building, or have your own purchasing agent contact her for you and try to get them to submit basically the operating budget, like trying to think the correct term for it, but it's basically that book that they'll send you that's got all the different breakdown of the rents they're collecting from each of the units. It'll break down all this expenses. It's like a net loss profit sheet they'll send you, so that way you can look over exactly what rents they're charging per unit. Based on this price per unit of $220,000, typically you can charge about 1% of the value for the rent. So they're probably collecting about $2,200 a month in rent for each unit. So that, they're looking at 26 grand in total rental income for one unit, and then they're going to have all their expenses that get shared among all 10 units. So that's just a little preliminary research you can do on LoopNet. So let's go back out here now. This is a prime example of a good apartment complex that somebody's already fixed up and is trying to flip or cash out now at top value. Let's see if we can find a distressed apartment building. So looking at these cap rates here, this is how I quickly screen. I just look at the cap rate. So 4%, 6.9%, 4%, 5%, 6%. So this gives you a feel for the cap rate for the Miami market just by looking at all these and seeing that they're all around 5 to 6%. You even got one here that's a 3% building, 4%. So these are, getting real slim as far as return on investment. Like you're paying for that same, stream of income again. So here at 3.6%, and you're paying $2.2 million. So above earlier when we were up here, we were paying $2.2 million for $118,000 of net income, which put it at a 5.4%. So now down here, if you're only paying that same $2.2 million and the cap rate just went down, that means the net income's probably less than $100,000 here. So let's go ahead and open this up. It's an 8-unit building. We can scroll down to the financial summary. So their net operating income is $78,500. You can see the scheduled gross income here is $131,000. Then they have $53,000 in expenses. So that leaves them a net income of $78,500. So that's the whole deal with trying to buy at a high cap rate and sell at a low cap rate. Because you can see here, this property's only producing a $78,000 net income. That other property was producing $118,000 net income. So that's $40,000 difference there, but both properties are selling for $2.2 million because this one's trying to sell at a low cap rate while the other one was trying to sell up at a 5% cap rate. So, the nicer the building is, the better it's fixed up, fully occupied, the lower cap rate you can get for it. And that lower cap rate is going to raise the value of the property. So I think by now you guys get all of that. It's starting to click and make sense since I've repeated it enough. So let's move on to one other location so you can see how markets vary. So Miami, we just noticed anywhere from 3 to 6% cap rates. It's real low cap rates there. Now let's head up into Michigan. So more specifically, let's aim for, Edwardsburg, Michigan. Let's try to go up into Michigan. So currently Edwardsburg's such a small city that there's no apartments for sale. So let's just do Michigan as a whole state and see what comes up for them. Alright, so if we zoom in here where it's a little more clustered. So let's go into Detroit now. This is another metro city. So the results are going to completely be different compared to Miami as far as cap rate of Detroit. All right, so scrolling through here, you're seeing already we've got an 8.5% cap rate, 7.5, 6.6, 8.5, 8%. So far, these different results are showing that Detroit's right around an 8.5% cap rate. For these properties, these ones all look pretty nice as well. They're probably, I'd guess these are the ones that are out in the suburbs, because if you get downtown Detroit, they're still fixing up, renovating downtown Detroit. Quicken Loans is pretty much taking over downtown Detroit. That's the Cavaliers owner, Dan Gilbert, that owns the Cleveland Cavaliers. NBA team. He's fixing Detroit up, putting a lot of money into the city. So looks like Detroit's an 8.5% cap rate roughly. I'm guessing there's probably areas you could get even higher where you could buy, you know, at 10, 12, 14% cap rates. Next, let's go out kind of more rural. Let's see what Kansas City's up to. So Kansas City, Missouri, they've got a 6.5%. So not a whole lot of buildings here. I forgot we've got the screening here set to over 1 million. So you got to remember that. So let's bump that back down and see what happens now. So now there's a few more results that came up, and it just shows, you know, on request. So you got to request more information from the real estate agent. So that's not really working too good. Let's try Indianapolis, Indiana. Let's see what cap rates are in Indy. All right, so here we go. We've got 7%. We've got a 14% cap rate, 10% on request, a 9%, a 12%. So here, you know, we can see that Indianapolis has a little bit higher cap rates, around 9, 10, 12%. So overall, this is, you know, a good tool for you. Like I was saying, go to loopnet.com. You can play around on here, looking up different cities, or you can look up your own city, set different criteria. You want to set it to multifamily apartments, set your price range that you're shopping for, and then you'll start finding deals. So if we came across a deal like this, like a 4-unit apartment building that's selling at a 14% cap rate, you want to buy at the higher cap rate, because that means that, you know, you're paying a cheaper price for that net income than if they were to charge more. If they were going to charge, you know, $400,000 for that same amount of net income you're buying, that cash flow that you're buying, that would make the cap rate go way down. So you're trying to buy at a high cap rate, you're trying to sell at a low cap rate. So I would look at, you know, this 14% property would interest me. I'd check it out, you know, see what kind of net income it's producing, see if all the units are, you know, occupied. That way, if they're not, then you know right away that just getting all of them occupied, that's going to raise the net income even more. The other thing you can do is look at the rents, see if they're up to the market rent. So if you notice that rents are only $600, $700 a unit, and you know in the market you could get $800 or $900 a unit, you could go in, do some remodeling of the units and start putting new tenants in there for $800 or $900, and that'll raise the income of the property as well. Once you've got it fixed up, fully occupied, you're charging the maximum rent you can charge, then you can consider putting it back on the market at a lower cap rate, and you could, you know, resell the property for $300,000, $400,000, $500,000, whatever it works out to be once you take that net income and divide it by the cap rate that is the market rate for Indianapolis. So thank you so much for being here today, watching this YouTube video. It's a little longer video today, but we covered a lot of information on valuing multifamily. In the future, I'm going to be creating more screen capture videos like this. We'll do some more live deal examples where I'll go more in depth than I went today. We'll actually break down, you know, analyzing a property that's got the actual financial information online, so we can actually look at what all the units are renting for, and, you know, do some research trying to figure out what market rents are and see, you know, how the whole process would go of researching a property. So stay tuned for that video. Until then, you know, play around on LoopNet, and be sure to tune in tomorrow as I upload the next video. I'm uploading every single day, so I'll see you guys tomorrow. Take care.